Hello, believers. This is Tushar from Wire Team. Welcome to your monthly market update for October. As we step into October 2025, a month that could decide the market direction for the rest of the year. After a volatile September, investors are asking one question: will the bulls take charge again, or are we in for more consolidation? Let's break down how the market performed last month, what's driving the sentiment right now, and what to expect from Indian equities this October. The Indian market closed September with a marginal gain on the benchmark Nifty 50, but it was marked by a sharp sector rotation. The domestic facing cyclical sectors like PSU Bank, metals, and auto were the clear leaders, while global linked and high valuation sectors like IT and consumer durables saw significant profit booking and underperformance. The broader market, especially CNX 500 and midcaps, continued to outperform, though some froth was visible in smaller names. October's outlook is cautiously constructive, driven by the kickoff of the Q2 FY26 earnings season and the festive season demand. The RBI's recent dovish stance and stable repo rate provide a strong tailwind for domestic growth, favoring sectors sensitive to lower interest rate and high consumption. Let's move on to the global cues. What's driving the sentiment? Globally, the tone remains cautious. Inflation in the US and Europe is easing, but not enough for central banks to go all out on rate cuts. Markets are pricing in rate cuts by early 2026, but the recent data has kept investors on edge. Oil prices have been volatile, the US dollar remains strong, and foreign institutional investors continue to book profits in emerging markets, including India. That's been a major headwind in recent weeks. Back home, India's fundamentals remain solid. GDP growth is expected to stay above 6.5%, inflation has cooled off, and government capex continues to support infrastructure spending. However, what's missing is strong FII participation. So far this year, FII have sold over 2 lakh crore worth of equities, largely due to global rate differentials and a strong dollar. On the brighter side, domestic inflows remain strong. SIPs are hitting record highs, and the 8 billion IPO pipeline lined up for this quarter shows investor appetite remains intact. Coming to the charts, Nifty 50 is currently trading in a tight consolidation range with a strong support at 24,400 and resistance around 25,500. A breakout on either side of this range could lead to a strong move in that direction. Looking at the price action, the index continues to form higher highs and higher lows, clearly indicating strength on the upside. If the market closes above 25,500, the first target would be around 26,200, followed by a possible move towards all new all-time highs. With most of the negative news already behind us, the market seems to have limited headwinds for now. Unless, of course, comes out with a surprise announcement that rattles global sentiment. Moving to the next chart, Bank Nifty. The index saw strong participation from PSU banks, which helped it gain momentum from the previous demand zone near 54,000 levels. However, it now faces a major supply zone around 56,000, which remains the key resistance to watch. Looking at the recent price action, Bank Nifty has broken out of falling trendline and retested the zone successfully, while also respecting the demand area, a sign of renewed strength in the trend. The index has already formed a higher low, but it yet to confirm a higher high. Once Bank Nifty closes above 56,000, it could open the gates for a rally towards 57,500, followed by a potential move to new highs. With the recent accommodative stance from the RBI, sentiment in the banking space looks supportive, and this could further fuel the upside momentum in the coming weeks. Moving to the next chart, CNX 500, the broader market index. The index has been consolidating since May 2025, trading within a range of 22,400 to 23,500. Similar to Nifty 50 and Bank Nifty, the CNX 500 is also forming a higher high and higher low structure, indicating that the underlying trend remains positive. However, The index is currently facing strong resistance from a falling trend line on the daily time frame. Once this trendline resistance is broken, we can expect a broader market rally of nearly 7.5% from the current levels. On the downside, support is placed near 22,400 and any dip towards this zone can be viewed as a buying opportunity for a low risk entry into quality stocks within the broader market space. Let's now shift our focus to the sectoral front. Before diving into the sectoral charts, let's first take a look at how different sectors performed in September and understand the key reason behind their performance. First, PSU Bank, which was a strong gainer with around 11.4% of gains in the month of September. The key reason behind the performance were strong asset quality improvement, government recapitalization, merger talks, and attractive valuations led to a sharp rally. The second one is metals, which was also a strong gainer with around say 9.7% of gains. Reason behind the performance were resilient domestic demand, China's stimulus talks, and a weak US dollar provided a boost to commodity prices. The third is auto sector with around 6.3% of gains. The reason behind the performance were early anticipation of festive season demand, inventory restocking, and robust performance in the SUV premium segment. The fourth is IT sector, which was a weakest performer with around negative 4.3% of losses. Persistent pressure from global recession fears, weak discretionary tech spending in the US, Europe, and adverse currency deal win uncertainty were the reasons behind the weakest performance. The last is consumer durables, which was also underperformance with negative 3.8% of losses. Profit booking after a strong run, high valuations, and concern over rural demand and elevated input cost were the reason behind the underperformance. Now let's look at the sector specific charts. Let's start with the auto sector. After a strong breakout from the head and shoulder pattern, the auto index surged to an all-time high and is now retracing some of its recent gains. Key support is seen near 25,800 levels, which also coincides with a gap support zone. Any dip to this level is likely to attract buyers, and we could see a rebound from here, signaling a continuation of the uptrend. Next, let's look at the capital goods sector. The index broke out of its consolidation zone and has now retested the breakouts level successfully. Key resistance is seen near 71,600 and the index has the potential to move up by approximately 10% from current levels. The risk reward ratio at present is favorable, making this a compelling setup for buyers. Next, we move to the IT sector. As highlighted in our last monthly update, the IT sector continues to face pressure due to macroeconomic concerns and prices are showing persistent weakness. Currently, the sector is trading below its first support zone at 34,100. Any uptick in prices could present an opportunity to short. A break above 36,600 would trigger short covering, but until then, the strategy remains sell on rallies in this sector. Next, let's look at the metal sector. After breaking out of its consolidation zone, the index moved towards the previous all-time high and has now surpassed the resistance zone. Some profit booking may be expected at these levels. The trend remains strong, and buying on dips, especially on the retest of the breakout zone, can be considered. If demand in the metal sector stays robust and there are no adverse changes in China's economic data, this sector is likely to continue outperforming in the near term. Lastly, let's review the pharma sector. The index is currently struggling with multiple resistance levels and is trading near the lower end of the right shoulder of the inverse head and shoulders pattern. A drop below the right shoulder could lead to further decline of 7 to 8%. Conversely, a break above 23,000, the neckline of the inverse head and shoulders pattern, would signal a trend reversal and the potential upward move in the sector. Let's look at to the key market drivers for October 2025. Q2 FY26 earnings season, the most critical domestic event. Focus on management commentary on demand outlook for the second half of the year. H2 FY26. Stronger results are expected in financials and industrials. Volatility in IT can be seen. Second, RBI monetary policy, which is already done The decision to keep the repo rate stable has set a positive backdrop for interest sensitive sectors such as auto financials, mitigating a major near term risk. The third is FII versus DII flows. FII remain net sellers in the short term, but DII continue to provide strong support, soaking up FII selling. A sustained FII return would be a major positive trigger. The fourth is oil prices and rupee. Elevated crude oil prices remain a major domestic risk, impacting oil marketing companies, widening the trade deficit, and pressuring the rupee. Any sharp spike is a headwind. Let's conclude the monthly market update for the month of October. The Indian market's performance in September 2025 signaled a clear rotation, a strong preference for domestic cyclicals over global linked defensive sectors. The outlook for October 2025 is characterized by bullish bias but stock specific. The primary investment theme will be the domestic growth cycle driven by first, festive demand, which will be helping to boost volumes for auto and consumption companies. The second is credit offtake, which is favorable for banking and financial services sector, supported by the RBI's accommodative stance. The last one is government capex, which will be continuing to fuel the capital goods and industrial space. Investors should buy on dips in these domestic focus sector while exercising caution in IT and pharma sector. The overall market will give breakout and sustain only upon a decisive global macro improvement or overwhelmingly positive Q2 results. Thank you for joining in. Wish you a profitable week ahead.